Good morning, everybody. Kirk Spano, April 27th. Happy Saturday to you. It's almost May. I think I'm actually going to go to a garden center and pick up some seeds at a minimum and maybe start my herb garden because I start that with seeds and it's okay if it's a little cold at night for the seeds. What other seeds do we have in the investing world? Well, the tree rings report this week I thought was very, very instructive, or at least very, very informative. And I'm going to go through a bit of that because it hits on some points. And again, I'm going to show you where I disagree that I think really point out what's going on in the world if you take a look at it through the lens of America is a bit exceptional and demographics do matter. Immigration does matter. Central banks are probably overstated in their importance. Fiscal policy is probably not as bad as people think. However, there is a cognitive dissonance that increases, and I have seen increase over the years, mainly because of the internet, that makes people look at the glass as half empty, which I think is the wrong approach, especially given the improved standards of living across the world the last 2 generations and the increase in general wealth in the last 2 generations. I think the half glass empty approach is wrong. I think really the glass is about 60 to 80% full, and we just need to figure out how to give everybody a drink out of that glass to get another half of the population to the right side of the improved standard of living curve, which is going to be difficult because we have a hard time with anything that is dealing with means and medians because people don't understand the difference. And certainly we have a misperception of money when it comes to big numbers. And the problem that I think that we don't quite realize is that when you take a look at money and people want to chant the inflation drum, they don't have the perspective that I think they really need. And it's a hard perspective to have. I was an applied mathematics and physics major when I started college. And I stopped with that because there were kids, the kids who are inventing the stuff that you use today, that could see the numbers and the relationships in a way much better than I could. And I guess maybe that's not even the right way to describe it. They could do it much faster than I could. Where I can study something, especially other people's work, and understand it, trying to do the scientific work, the rigorous development of theory, and then testing into the theoretical realm that requires other people to check it, I couldn't do it from scratch. And I realized that within a year of working with these kids who would say things so matter-of-factly that I was like, holy shit, how do you understand that already? And that's when I realized that my scientific and mathematical prowess, while certainly in the top 20%, was not top 1 or 2% stuff, right? I was not like Neo in the Matrix where I could just pick the bullets out of the air because I saw the code with which they were created. So I switched to pre-med for a hot minute and pre-law for a hot minute. And then I noticed in my 3rd year, which was actually my 4th year, but I had taken an almost gap year. My sophomore year, I took 1 class each semester just so I could have access to the gym. And in hindsight, not the greatest financial decision because I actually took the same class both semesters because the first time I failed it, or I didn't get the C- that I needed. And it cost me something in the realm of $800 or $900 be a member of the gym at the UW Milwaukee campus. Well, I could have just joined Golds for $25 or $30 a month during that time period and probably gotten in much better shape because at the UWM gym, I just really tried to scope out girls, and while that went okay, I did not get ripped. So good financial decisions, ulterior motives, all these things are ulterior motives, as you say in the rest of the world. I figured out that economics was my calling because I was overqualified on the math, whereas with physics I was underqualified. So quite the big difference. And what I find with economic analysis from a lot of people is that they don't understand something that a scientist would understand. And that is the universe is expanding. How does that apply to the financial situation in the world? Well, I want you to think about this. The wealthiest people in the world, I'll call them the Smog the Dragon class, are so rich, think Elon Musk, that it's almost unfathomable how rich they are. And you have a group of people in the world who are like, oh, but they earned it, so they deserve it. And that's kind of bullshit because it's just not true. It's not even kind of bullshit. It is bullshit. Elon Musk is brilliant. I won't take that away from him. He's weird. He's on the spectrum somewhere. You know, he's got a condition that makes part of his communication with the world challenged. You can hear in my voice, I'm trying to be diplomatic with the guy because he's done some amazing things. But if I was sitting with him in a bar, listening to him talk about the world, I would think he's just some drunk, discontent, unhappy with the world weirdo that probably had some 9-to-5 job that he didn't like. You know, it'd be hard for me to pick out that he's brilliant sitting in a bar because I see the things that he puts on XTwit and I think to myself, Jesus, some of this stuff is pretty out there and clearly, demonstrably having been proven wrong throughout history. But there's a lot of people who want to grab onto the nationalist, semi-racist, inward-looking. Man, there's just so many ism words I could use here. And again, trying to be diplomatic. But, you know, when we take a look at fascism, when we take a look at racism, when we take a look at nationalism, and I don't know what the word would be, but religionism and just extremism of so many ways, that what you find is that those are the things that screw up the world. And he's grabbed onto a couple of them, lock, stock, and barrel. And I don't know if he believes it or if it's just part motive. As I've told you in the past, you know, I've been in that world. You know, I got a job offer from Steve Bannon's group, and the Koch brothers came over after me. I mean, I've had some interesting job offers over the last 20 years, and I'll just tell you, I don't know who believes what. I don't know what these people believe, but I know that they get rich saying it. And as Grandpa always said, follow the money. So I think a lot of the shit that's out there is just the same old playing to the fringes because you'll make money doing it, and that's what happened. But then it finds its way into the narrative, into the social and economic and political and ideological narratives. And the internet has amplified that by 100-fold. I mean, it's just off the chart. So when I talk about money and the expanding universe in the same breath, I think it's important to understand that the people at the super top, your top 0.5%, your billionaire class, a lot of them have found in economics what we call an inefficiency. And inefficiency is where pricing mechanisms don't work properly. Monopoly pricing pressure is one of them. But being able to capture an inefficiency in the economic system, often helped by government policy, if not almost always, is what makes a lot of people rich, like super rich, uber rich. So let's cut off that 0.5% and then look at the way the strata work financially. Those super wealthy are really just a mechanism to pull everybody else up. And I don't necessarily believe the trickle down stuff. But what I mean is that by letting the inefficiencies occur, we're putting so much money into the system that the money does in fact spread out. At some point we run into a situation, and I'm getting to the point here. At some point we run into a situation though, that because some of the super wealthy Elon Musk got rich directly because of government largesse, whether it's tax breaks or direct incentives or outright checks written or regulatory policy that favors them because they bought, you know, a senator, Kristen Sinema, Joe Manchin, half the Republican Party, they get super rich and then they preserve it. Money leads to power, power leads to more money, and it's a cycle. It's why Teddy Roosevelt, Republican Teddy Roosevelt, said we need to have a good estate tax so that idiot sons don't inherit all kinds of money and then really screw things up because they have too much power and they have no perspective and they were just rich trust fund babies that never earned anything, and that warps them. That was essentially Teddy Roosevelt's view, Republican. And I agree with it. I think the estate tax is one of the most important taxes for preventing dynastic wealth that ends up corrupting the political system. Again, Teddy Roosevelt, Republican. And I think that when we take a look at these moving parts, we have to think about, okay, what happens when debt gets out of whack? and you have billionaires out there who made most of their money, or at least big hunks of their money, because of inefficiencies in the tax code, in the regulatory structure, in the way that government money is handed out. What do? Do you go to the other 99% and say, hey, we need to raise your taxes a little bit? Or does it make sense to go to the 0.5%? Over 80% of the debt is from tax cuts in the last 23 years. About the same time I've been investing since George W. Bush. Remember, when George W. Bush took office, Bill Clinton and the Republican Congress had basically balanced the budget. Since then, George W. Bush put on steroids what Ronald Reagan did. And what Ronald Reagan did, David Stockman, I don't know if he was a Treasury Secretary or what exactly his job was, budget director, I think, actually. David Stockman has said they made a mistake. He said, look, we were supposed to keep spending flat and then tax cuts would drive growth. But what we did is we spent a lot of extra money to get the tax cuts. So we compromised. And one side of the aisle, they said spend more money. And the other side of the aisle, they said tax cuts. And that was the start of the U.S. debt. Clinton flattened it out. And the first George Bush Sr., George H. Bush, he actually, he got crucified for read my lips, no new taxes. And then he had to backtrack. And it was the right thing for him to backtrack, but he lost his election because of it. Bill Clinton came in and essentially sort of followed George H. Bush's policies for the most part. He's a very centrist guy. But then George W. Bush came in and said, well, I'm going to do what Reagan did, but I'm going to supersize it. Obama tried to fix it, ran into tremendous opposition starting in 2010 from the House of Representatives, which went Republican. It's important to realize where the U.S. debt comes from and how it could be fixed. Because why? Because things that make sense eventually happen. Winston Churchill, Americans will try everything and then eventually get to the right thing. And I think that's where we are. And I hope that Janet Yellen lives to be 120 years old because she's one of the smartest people out there. And she understands what I'm talking about. Or I should say, I understand what she's talking about. So I don't know that I would have come up with some of this stuff if I hadn't read and studied some of the things that the smartest people in the country have been saying for a long time. I was lucky to be exposed to Harry Dent in the 90s and then read The Fourth Turning probably 20 years ago. So I understand that demographics, which is something that I tried to figure out as an economics student and apply, but nobody was really into it. It's why I got a C on a paper I wrote that's turning out 40 years later, however goddamn old I am, 30 years later, to be mostly true. I projected the path of the global economy in 1993 or 2. And I used demographics and the expansion of the middle class in the emerging markets. I was basically told that's not how the laws of economics work. It'll never turn out that way. And what I said was going to happen is that we were going to get to a point where economic growth slowed globally, that standards of living got very high. And so long as we didn't find reasons to kill each other and blow each other up, that sometime by the middle of this century, I put it at 3 to 5 generations. Fourth Turning hadn't been written yet. I didn't know that there was a 4-generation thing that kind of repeats itself historically, going back a couple thousand years. But here we are into the 3rd generation since I wrote that paper, the very start of the 3rd generation. The standard of living is going up across the globe at the same time that growth is slowing down. And it's because we have that expanding financial universe, that money, even though it gets hoarded at the top, enough of it finds its way into the rest of the system to pull people up. And not all people, it seems like only around half. So how do we fix the debt problem, which we'll have to fix over time, given that slow growth forever, right? My slow growth forever theory that I posited about 10 years ago on MarketWatch seems to be playing out. Right? There's over 30 years of evolution of my thought process here, and it's proving to be mostly right. Do I get every trade right? For sure not. Every investment right? Absolutely no. But by being on the right side of these big, huge trends, getting better with the timing, which is just based on math psychology, Gartner hype cycle stuff, understanding that a lot of things are amplified now because of the internet. And I do think that we might be seeing a little bit of a pullback now that social media has become diluted, right? It was different when there was only 2 or 3 social networks, and now there's a couple dozen around the world. It's different. It's maybe getting to the point where actual literature and writing and deeper analysis could, in the current generation, become more discerning. That'll be good. If you read the Fourth Turning, and I think you should read the Fourth Turning, what you'll find is that the millennials, generally a pretty strong generation, except for the weird group of men, not a lot of them, it's like a million. And I've studied the psychology of this cousin and a number of other people I know who are 40-ish, never worked full time, mostly have not been married. A lot of them still live with mom or mom and dad or one or the other. And I don't know what to trace back their deficiency to because it is a deficiency. I don't know what happened in the 1990s, which is their teen formative years, that made them live their life in a haze. I don't know what caused that. During the 90s, it was the period of my great illness. I, of course, got divorced in 2000 and got much better. So I may have missed something that happened in the 1990s. Was it 90210? I don't really know. I don't know why there's a group of 40-ish-year-old men who are just slugs. But if you put them aside, the millennial generation has been very impressive to me. And I hang out with them a lot because of poker and baseball and things like that. And what I'm seeing from Gen Z is they're an even, well, so I've described millennial generation before. They're kind of passive aggressive. And I do think they're prone to some of the extremism because of the cynical nature that they developed from 9/11 and then a financial crisis in their 20s. The Gen Z group, though, very in talking to them, because through my daughter and my son, but mainly through my daughter, I've met a lot of them, and we have talks, and our friends who have kids going to college now. They don't have time for a lot of bullshit. They have time for little stupid little phones, but they don't have time for a lot of bullshit. So while they bullshit around on their phones, in face-to-face conversations or on the telephone or in business, it's to the point. I'm here to do this. Let's talk about that, get it done. I don't know entirely what that means, other than I think you're going to see Gen Z, and the statistics right now prove this out, going to be very, very involved with small business. And it would behoove us as a society to focus on helping them with their small business ideas, which means getting some of the big people out of the way because they suck up the oxygen, they suck up the capital, they drive up prices that a small business person can't afford because the private equity guy wants to build an apartment building with a 15% internal rate of return. I get it, right? I've been involved in that. I have some other motives for being involved. I want to help create sustainable, walkable, small business communities with lots of people living around them and parks. And right, you've seen a handful of those get built the last 20 years. There needs to be more. So in this financial universe that's expanding with a lot of the money going to the very top 0.5%, how do we fix the things that are broken? How do we think about it as an investor? I think it's important that we grasp there's no shortage of money out. So if we really care about paying down the debt, then we have to figure out how to get some of that money moving from the 0.5% back into the system. Because a lot of it's just piled up like gold with a dragon on top. It's money that sits in bonds and in, which the governments, and this is a concept called crowding out that I never really thought we'd see a lot of, but we're starting to see it. Crowding out's real, and that's where government soaks up the available capital. We need to figure out a way to move past that, because right now there's only a couple solutions if we don't change the tax law and the regulatory framework, and that is either raise taxes across everybody else. I don't think any of you like that. Or we cut spending on retirement, Social Security and Medicare. I don't think any of you like that either. Or we cut defense spending. We can't even say that out loud in this country. Or you do massive quantitative easing and expand the financial universe even more. So we have this narrative right now. At the start of the year, the market, all the brainiacs there, thought there'd be 6 rate cuts. I was always on the 2 or 3 rate cut train. And now the market and all the flunkies are pricing in 0 rate cuts or even a rate increase. Why? Because they incorrectly, with their cyclical Austrian viewpoint, that doesn't take into account that the financial universe is expanding, has to have higher rates for longer to fight inflationary pressure. And it's just wrong. The demographics are the biggest factor in economics. Far and away, nothing's close. Those are deflationary across the 4 biggest economies: the United States, Japan, European Union, and China. So let's go back to the interest rates, because this is going to lead to what's coming in the financial universe. The market, in all its idiocy, thought 6 rate cuts this year. I've been telling you for 2 years now, the economy is much stronger than people think. I've said over and over again why that is. that the U.S. economy just is that strong. Massive geographic benefits, a rule of law that has worked, a financial system that's imperfect but has generally worked, skilled labor, which we're starting to run on, a shortage of. And the only thing that really challenges this government is the aging demographics, which are probably tomorrow's debt problem, right? The reason why you hear super rich people want to cut benefits, entitlements as they call them, is because they feel entitled to their tax cut. Think that one through. We've never had a tax cut that paid for itself, not in my life. And that doesn't mean that we should have much higher taxes. It just means that we should be more judicious about how we do things. So no rate cuts is what the market is saying now. I'll call bullshit on that. I'll take the over. Now, I do think that there's a good possibility that we get a rate cut over the summer, June or July. Certainly not going to be next week. And it could be described as a potential one-off. And the reason it would be described that way, it would turn out that way, but the reason it would be narrated that way so that the market didn't get completely overvalued. It's weird that the market doesn't think that there's a rate cut coming anymore, and yet they believe that eventually we'll get quantitative easing, and that's why they can invest so speculatively in the market right now. I would attribute a lot of the success of the speculators on the fact that we're at full employment, and that leads to a lot of money going into index funds, which just pulls the entire S&P 500 up. Mainly the companies at the very top, because they get the most money from the S&P 500 index, which are half of the money that goes into the market now. So I've talked about why the dollar would get stronger now for well over a decade. Constantly told I'm wrong. Well, somebody wrote a book, The U.S. Dollar Milkshake Theory, which I believe is correct. So go ahead and read that book. I'll put a link out there. And it talks about how the dollar could stay strong and influence things through that paradigm versus all the people who said the dollar was going to crash way back here. All the people were chanting, Jim Rickards and everybody else, the dollar's going to crash. And I said it's going to go on a long-term bull market, and it did. For the last 12 years, the dollar has risen. And I believe that this range here that I have marked in blue, it could be fudgy a little in either direction, but basically around 100 on DXY, and I'm going to call this the millennial dollar, is where you're going to see the dollar for a very long time. And I think there's even more of a possibility that the range moves up as we address our debt issues than the dollar moving down. Doesn't mean there won't be cycles where it comes down. I expect one of those soon. But then that'll be a corrective period for the budget, and then the dollar will get stronger again. So one of the reasons that people think that they can just keep investing in large cap equities is because ultimately we're going to get quantitative easing. And I do believe that is correct. My thought is that the quantitative easing may not come as soon as people think. I do think that the quantitative tightening that's going on right now is going to get wound down between now and next year. We know that because when you take a look at how the debt is funded, Janet Yellen has been doing more short-term debt than long-term debt, implying that 2 years out, in order to reduce the interest that we're paying on the debt, we're going to drive interest rates way down again, say 2026, which is when I project the next recession. So if you're reading this, what you're finding is that the quarterly refunding announcement, which will be Monday or Tuesday, is another thing, and the public doesn't listen to this. They just kind of know there's a Fed meeting. Well, this is Treasury, whole different thing. But the bond market pays it. So if Yellen says we're going to do more short-term debt, that means that quantitative easing is closer. If she says we're going to do more long-term debt, that means quantitative easing, at least their forecasting, is further out, which means that the people who are investing in risk assets indiscriminately are more at risk because they're not going to have QE to bail them out anytime soon. I said 2 years ago that one of the reasons that the Federal Reserve was doing quantitative tightening is they wanted to hold back the stock market from getting overvalued. And they largely did a good job because the stock market compared to 2 years ago was just barely up, right? There's a big kind of U shape in there, or V shape. It's taken a little over 2 years to play out. So we're just now breaking out the new highs in the last couple months since December, right? When we started flirting with new highs on things. And the small caps haven't got there yet, which is historically incredibly unusual, which is why I really like small cap. I think this is how this is going to play out. I think in order to bring the debt under control, a couple things are going to happen. And it doesn't matter who the president is because we're going to have split government. The Trump tax cuts are going to expire. The problem is that some of those tax cuts don't expire on the super wealthy or the corporation, which is where we need them to expire. And you're going to see your standard deduction fall back to where it was in 2017. That's really bad for the middle class. It is a mechanism designed to send money from everybody else to the richest 1 or 2% of the country. And it needs to be flipped over. There's a chance it is done right if Joe Biden is elected. Not saying it will get done right, just there's a chance. There's no chance it gets done right if Donald Trump is elected. And in my view, the odds of a financial crisis, and Leon Cooperman just talked about this 3, 4, 5 years out, is really high. I talked about that on Wolf Financial's Stocks on Spaces a couple of weeks ago, and I literally got yelled at by one of the panel members. We're not even close to a financial crisis or a depression or a deep recession. And I said, well, it depends on what your view of close is. I mean, if you're trading week to week, well, then no. But if you think that we can't have a horrible financial event this decade, later in the decade, you're way off base. Because I heard people say the exact same thing to me in 2006 and 7 when I was warning about a crisis and how I was so wrong and that we were nowhere close to a crisis. So we are at a point right now where we're going to find out in November if we're going to have a financial crisis. I think it's that cut and dry. If Trump wins, we get a financial crisis. If Biden wins, it's a coin flip. I'd rather have the coin flip than the certainty of a financial crisis. But it's coming because of the demographics, so many people retiring, and us having a hard time in our nationalist little view of the world that we need millions of immigrants per year. I don't know the exact number. It's somewhere between 3 and 5 million. Hard to know exactly. Because not only do you have to replace the baby boomers in the workforce, but you also need new people to help take care of them as they age. And think about me. I'm 54. My parents are 74 and 75. They're living independently. They just went to freaking Alaska and walked to the Arctic Circle. And not that far. I mean, they got dropped off, but then they had to do a little hike to watch the Northern Lights, which was pretty cool. I've seen the pictures, and I'll see the videos in June. Or I could teach my mom how to put it on Facebook. But by the time they need help, it's probably 15 or 20 years from now, right? Well, by then I'm 70, right? So we need all kinds of Gen Z immigrants to this country because they come in to the workforce immediately, and then they have families. So for the next 10 or 15 years, we'd be smart to have a smooth process of immigration to help with the boomer retirement and the post-boomer economy. Because otherwise, fewer people in the economy means that it shrinks, which is deflationary, which could turn into a depression. So when people talk about tightening interest rates because of inflation, they're so far off base that frankly, it's pretty laughable to anybody who has real economic chops. So when Janet Yellen is making these announcements about how they're going to fund the debt, and you take a look at the term structure, right, the length of the bonds, it is a huge tip to what they see coming, which is exactly what I just told you about. So we are going to get quantitative easing. I don't think it's till 2026 or later. And that means that if the narrative today among traders is no rate cuts, if they start to believe that the QE isn't coming sooner, right? Because right now they still think it's right around the corner, right? In one side of their trady little mouth, they say inflation, no rate cuts. Then on the other side of their trady little mouth, they say, but we're going to get QE. Do you see the conflict? Do you understand why I say that trader narratives are bullshit and just designed to get you to make bad decisions? Because those two things run counter to each other. The secular trend is deflationary. The United States should be okay because lots of people want to come here if we don't screw it up and go too socialist, or don't go any further to the rich controlling 70% of the economy, which is what they control. 1% controls 70% of the economy. We need to get that back down to 50. And imagine if 20% of the value of the U.S. economy and assets, which is trillions and trillions of dollars, about 300 trillion globally, if 20% of that flows to 300 million people through income over a period of years and asset accumulation. It is not difficult to solve our problems from a mathematical standpoint. It's difficult from an ideological and political standpoint. But because things that make sense eventually happen, if we don't kill each other, we'll eventually get there. If the women of this country win the election for Biden or Gavin Newsom or whoever is the Democratic nominee, I think we have a shot of avoiding a severe financial crisis. Because the next one, because it's generationally driven, could last a decade. it could be a Great Depression. One of the other things that drives the budget, tax receipts, correct, from investment assets, people selling appreciated assets. So you need the price of assets to continue to go up, at least in most years. There can be a down year from time to time, but we really can't afford more than 2 down years per decade, maybe 3 in a bad decade. We need basically 4 out of 5 years to be up years in the stock market. And that is transferred over to the real estate market, where home ownership is basically secured the boomer retirement. This is why boomers will survive, because so many of them have paid for homes or they have mortgages at 3%. There's just an article in Barron's that talked about why boomers aren't moving. So I would really recommend you look that article up. And it's because if they're in a house that's too big for them, they have room for the help if they have to get help someday or have relatives move in. And they're thinking this way. And by the way, my mortgage is at 3%. What do I care? It costs me more money to move. And that's why we need a lot more houses built. Not so much multifamily. We need single family homes built to the tune of about 10 million of them over the next decade or so, which is why I encourage every kid who's not sure what they want to do, why don't you just get into the building trades while you figure it out? Because you might end up having a great career on that. And did you know that job satisfaction among people who build something is like among the highest in the world? They go to work, they build it, they're happy that they built it, they go home and they do other stuff because there's not really anything to think about until the next day again. They don't bring their work home with them. They accomplish something every single day. That is amazingly satisfying. It's why I have been pushing into that arena. I want something more tangible. I've lived in an intangible world a long time. I'm good at it. I understand it. I've adapted. I can sleep at night. But what I described today is what I worry about. And this little nugget that I talk about here with how the funding works and when we might see QE is important. If this market starts to believe, and it's this week, I'm talking about this now because this is this week. You have the Treasury and the Fed back-to-back days. They can cause a stock market correction by the way they talk. And they're not bound by it. 6 weeks from now, they can change their mind because that's when the next meetings are. Well, for the Fed, Treasury's a little longer. So if Janet Yellen doesn't move the debt to the short end of the curve, short end of the term structure, I should say, and if Fed Chairman Powell is mean Jerome Powell this week, you can see maybe a really tough month in the stock market. And if that's the case, right, if they've decided that we need a little bit more breather in the stock market, they'll both talk that talk. If they don't think we need a correction of 5 or 10%, then we get to 5,700 on SPY a lot faster than I thought. You'll notice that my January prediction that we get to 5,700 on SPY this year, but with more upside in small caps, it's been right on the large caps so far. Small caps haven't caught up yet. They show signs. I don't think until they cut rates, they're really going to take off. You got the micro caps that'll get added to the Russell 2000. That'll be important. But I think small caps as a group need interest rates to fall. And because small caps are an inefficient market, right? Not a lot of information getting in everybody's hands there, right? Inefficient markets is where you can find the gem. Because in the large cap market, everything's already uncovered and polished up. Everybody knows everything. There's very little to know in the large cap space that isn't known. Markets price it in pretty quick. And then it just becomes a matter of liquidity. And the liquidity, as I mentioned earlier, comes from the fact that we're at full employment. If unemployment goes up, if we have a real honest-to-goodness recession, the floor on the S&P 500 is way down at around 2,000. So be very afraid of the next recession. Maybe we'll fade it again. I mean, we just faded it. But they can't keep interest rates high and avoid it. Maybe they want a crisis so they can print, $5 trillion again or $10 trillion next time. I don't know. I don't know if they want a crisis. It seems to be the only time anything gets done correctly. All this stuff that we bitch about with the COVID bailouts, it turns out that it was all basically right. But you have the inflationistas out there going, oh, it caused inflation. Dude, inflation's 2.8% right now. And it's been coming down for 2 years. To the point now where we have one last step to get before it's at the target rate. And if we ever address the housing issue, it's completely fixed because we know that energy is just going to keep getting cheaper, right? We're in a CapEx period now building out the grid and all the alternatives. By the 2030s, that's going to be mostly done, or at least enough done that, the capacity is there for AI and everything else. Energy is just going to keep drifting cheaper until it falls off a cliff. Housing is the big issue. We need 10 million more houses, give or take, over the next decade. So that means that there's probably going to be a program Biden wins, it'll be next year, where there's big tax credits for building a house. Not necessarily buying one, but building it. And I would love to see that happen. And it should be tied to some sort of national apprentice program that companies can participate in and partner with junior colleges, because they're afraid of unions, to get people into the building trade and the skilled trade. They go hand in hand. There are easy solutions out there mathematically. It's the politics and the ideology to screw things up. We'll see if we need a crisis to fix it or not. If Trump wins, you're going to get your crisis. If Biden wins, it's a coin flip. I'm going to keep saying that week after week because I need you to understand it. Because if Trump wins, you can't go running for the hills. You'll start game planning the biggest big short in the history of the world with it, because it'll happen. Interest rates are going to go down this summer because they have to. Otherwise, we get a recession. And they need to set it up with one rate decrease now. And I just keep believing that he's going to describe it as a potential one-off. We're not sure if we're going to keep lowering rates. We're not sure if this is the start of a new cutting cycle or if we're just flattening out the yield curve a little bit to help the banks and the home builder. All these things could be explained, and they do get talked about. They, for whatever reason, they don't make it into the media very often because the media likes short, sweet, and easy to understand. You need to watch Wall Street Week on Bloomberg, best program on TV as far as I'm concerned for financial stuff. If you don't have the Bloomberg app on your TV, download it today. Don't wait because you'll forget. Download the Bloomberg app, start watching it. It is laid out even better now. They made an improvement with the last update. Wall Street Week, and then they highlight the interviews. There's a Bloomberg YouTube channel. I think it's called Bloomberg TV YouTube or something. And that has a lot of the interviews. You can get 90% of the news you need from everything that Bloomberg does. I'm just telling you. It is far and away the best news and financial news source in the world. Add some New York Times and, Wall Street Journal and some of the international papers for more political and other stuff. But for just as an investor, you have to have Bloomberg. It's the $200 a year that I tell you have to have. TradingView is close. I mean, if you're really selling options, you got to have trading. This is what's coming. It's not higher for longer. It's not inflation. It is the threat of deflation and a potential financial crisis that you should be worried about. Because as soon as this election is over, the Saudis and the Russians put more oil into the market. They're trying to screw with our politics. And at some point, the Chinese have to create incentives for the Chinese to actually buy the stuff they build. And that is the pressure that Biden is putting on them. That they have all that productive capacity and they don't buy any of their own stuff. They have to create a system there that's much more American style, but the commies in charge fight it. And that, I guess, is the other potential financial economic crisis. But we're insulated from China pretty well at this point. The last, since Obama and Trump had some success here too, we've insulated ourselves from China quite a bit. And as things continue to onshore, and as small businesses hopefully help, right, all these things can work. Hopefully it doesn't take a crisis to get there. We'll see. In the very short run, I would expect a little bit of a correction in the stock market. And I think it's very viable for investments that you plan to hold for the next year or two. Now, ETFs, easy to go in and out of. Stocks, telling you, still small caps and micro caps where the value is. Some mid caps too, especially mid caps that might get onto the S&P 500. Now, your $20 billion companies that aren't on yet. There's very little in the S&P 500 worth buying individually. Anything more than the 30 or 40 stocks that I cover. You still have a couple hundred companies in the S&P 500 that are zombies. Just right now, the zombies are hanging out with the living. That won't last forever. And if the S&P 500 gets into the 6,000s, as I expect, that will be a market top that probably gets tested 3 times. And whether the S&P 500 corrects all the way down to 4,000 or 3,000 or 2,000, we'll see. But I expect that in the next couple of years, we'll enter a choppy period in the S&P 500 that lasts a very long time as we work through all this economic stuff. And gradually, indexers will say, well, maybe I'll put a little bit more into IWM. It's not the right approach. You ought to just buy the best small caps individually, pick out a dozen. But, fund investors are fund investors, and that's what most people have in their 401k to begin with. So if people start allocating a little less to SPY and a little bit more to a mid cap and a small cap index in the future, because those indexes are outperforming and they notice after a year or two, that'll lead to a period of outperformance. And remember, as more and more baby boomers retire, the pensions go into a period of drawdown. They're basically flirting with that now. And they're mainly owning bonds and large cap. So that puts pressure on both of those markets. And they'll fix the bond market pressure with QE. But in the face of pensions selling into the market and indexers buying that, those forces offset. And you get a choppy period in large cap that, again, I think lasts a very long time, well into the early 2030s or even middle 2030s. What we want to do is avoid a depression. Watching these interest rate signals this week should get you to understand what I'm talking about, because it's super, super important. And learn about this milkshake theory. And remember, Bitcoin is the hedge against the dollar getting too strong, not too weak. I mean, I know that's the common wisdom that Bitcoin is a hedge against the dollar getting weak, but I showed you the chart. Dollar's probably going to be in this range and then end up higher, because once we flatten out the budget, how does the dollar not get stronger? And that has a direct impact on gold, which has been, take a look at that range. Probably. Well, we'll go all the way to the bottom. I'll be there. That's the, come on. There you go. There's your range on gold. Gets underneath for a while, gets in here, now it breaks out. Do I think it goes higher for a while? Yes. And I think that this ends up getting stretched higher. This bottom, because the price of mining it goes up, moves up too. But I think there's limited upside on gold. And as Tree Rings pointed out, gold largely had to do with China here recently, because we have seen outflows from the gold ETFs up until this week or last week. So that means that Americans are starting to chase gold, probably at the same time that the Chinese are done, which means that the people buying gold right now are going to be the bag holders. You have Newmont Mining, and I'm pointing this one out because some of you bought it on my recommendation. When it was down in the low 30s, some of you bought it. Now it's in the low 40s. You should probably keep this spot right here in mind. You should probably be thinking about an exit strategy with almost all of your holdings. If you want to hold on to a little bit, I'd actually say probably sell all your Newmont stock for a profit. Then if you want to gamble on a spike, buy some calls. Because here's what we know about miners, just like we know about telephone companies, is that the CapEx is perpetual. There is no way to become asset light. Just because the price of the commodity goes up doesn't mean that you have perpetual increased income, because it becomes harder to get more, right? It's harder to find more gold. So the price of the gold for mining it goes up as well. So I still have Newmont on my dividend list because it was at value. If it breaks by about 45, 46, 47, probably take it off the dividend list because it's not cheap anymore. And a lot of you will be up 30, 40, 50% at that point. I like selling covered calls on any rip here because, again, gold is just not that valuable in reality. Most of the gold in the world is sitting in bricks in safes. Doesn't take much to do the jewelry. Very little of it is used in technology. So, I told you the story that somebody's walking around with a 1 ounce gold bar, using it as their chip protector in some of the poker tournaments I'm in. I never even occurred to me that that's what he was doing. So, how valuable can it be? It's jewelry, it's decoration. There's some value in that, but there's not industrial use. Silver is probably safer, but even limited upside there, because technology is reducing the need for silver in industrial use, just like technology is doing in a lot of places, hence disinflation. All right, this was expanded major markets. We're not going to do major markets anymore on a weekly basis. We'll do it once a month, and we'll probably just pre-record it. But the charts are still over at Fundamental Trends, so you can sign up here for free, and you can get the charts in the macro ETFs and special reports section. I combined Global Trends ETF with this so that people can see the macro approach. Shooter put in the major markets charts here. We're just not going to talk about them except on a monthly basis because things don't change that fast. We were doing a show for the sake of doing a show, and I got better things to do with my time. So we're going to do major markets once a month now. And Shooter will have some updates when he does his primary waves during the week. So if you go to the YouTube channel, Shooter's stuff will be up here too. All right, have a good weekend. Get out in the sun. The weather's warm in Wisconsin today, so I'm going outside. Take it easy.